All right, I want to thank everybody for joining me today. My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today, we're going to go over quite a few different things. We'll talk about common 401k mistakes we see amongst Fortune 500 companies we do a lot of work with, a little bit of tax planning, talk about inflation and the transition process from an employee to retirement. Before I get started, I just want to remind everybody that the Retirement Group, we're not employed by nor are we endorsed by your individual company. We've been working with specific companies for about 30 years or so, helping employees transition into retirement. So we've got a deep understanding of your plans probably. So if you have any questions on those, feel free to give us a call. There is a Q&A box on the screen. So if you do have any questions and you'd like me to try and address those at the end of the webinar, go ahead and put your information in there. It is anonymous, so your name will not show up, just the question will pop up, and we'll try to get to as many as we can by the end of the webinar. If we don't get to all of them, we'll be sure to try and follow up with you as well. There's also a chat box there, so we will be putting some information in there periodically throughout the course of this webinar to keep you up to date. Different items like how to schedule an appointment with myself or one of the other advisors in the office, how to get access to our LinkedIn page so you can follow along your company's specific plans, get updates on future webinars we have there. There may be a survey in there as well, where if you have any ideas for us to either make our webinars better or new ideas for new topics, let us know there. We'll be happy to oblige you. And then there'll also be a spot in there, I believe we'll put the links to the next webinar, how to sign up for the next general Fortune 500 company webinar. But again, if you have any questions as you go through this, go ahead and follow us on LinkedIn. We'll be able to provide you with updated information as new webinars come about as well. So as I said before, we're not affiliated with nor are we employed by your specific company. However, the Retirement Group, we've been working for about 30 years with a lot of different specific companies, about 20 different companies specifically. So we have a deep understanding of their benefits plans, whether it be the pension, the 401k, health savings options, and the whole retirement planning process. Our goal there is to help you prior to retirement to make sure you understand that transition and avoid a lot of mistakes we see from time to time. And a lot of times this can save you tens of thousands of dollars in that planning process. And we do have offices throughout the country, so rest assured, if you need to sit down with one of us face-to-face, we can still accommodate that. But obviously we can do web meetings, email, chat, phone calls, all of that's available as well. But ultimately speaking, at the end of the day, if there's anything you take us up on, or if it's been at least a year since you've done so previously, is let us run a cash flow analysis for you. This is actually a complimentary plan where we can take a look at what your goals are. If you've got a specific retirement date in mind, and we can take a look at what you think your spending is going to be, what you saved so far between the 401k, the pension, other outside assets, what your savings rate is, and are you on the right path to meet those goals? And we'll definitely tell you the truth. We're not going to paint a rosy picture. If it means that you should work another 3 or 4 years before retirement or need to bump up your savings, we will let you know. But it also could come out the other way, where we uncover the fact that, hey, you can retire a year earlier if you want to. And how do you quantify an extra year of retirement versus employment? Also, if there are changes to interest rates, which affect the pension lump sums, or changes to the stock market, or changes to company plans, that may dictate whether you should go earlier or later as well. So all those are going to be more one-on-one specific information that cash flow analysis can uncover. So as far as getting to the topics today, one of the first things we'll kind of address is some things that changed about a year or two ago with the Secure Act of 2020. We'll go through the minimum required distributions, some different stretch IRA changes, and we'll talk a little bit about the tax brackets as well before we get into some different strategies for that transition process for employees. First and foremost, one of the key benefits of the Secure Act back in 2020, it was actually signed in December 2019, took place in 2020, was the extension of the RMD, which is your required minimum distribution. What happens is if you don't need the money, whether you need it or not, come age 70 and a half, it used to be, but now it's pushed back to age 72, the IRS will force you to start taking distributions from your IRA or 401k, essentially so they can start taxing you on it. So that was pushed back from 70 and a half to 72. So it gives us about a year and a half more of planning strategies for those of you that may not necessarily need the RMD. That means another year and a half of potential Roth conversions as well, which we'll touch on a little bit later in the presentation. Another key issue that was actually a very negative change, and unfortunately I experienced this very quickly in January of 2020 with one of my clients who was a divorcee, passed away, and left his assets to 2 of his kids. It used to be that you could have a stretch IRA, in which case if that individual had passed away, his kids could actually distribute that over their lifetime and minimize the taxes. However, that changed. So the way it stands now is if you pass away and you leave your tax deferred account, whether it be 401k or IRA, over to your spouse, he or she can take it into their own plan. So they have tax deferral benefits there. But if it's going to a non-spouse beneficiary, so let's say kids, for instance, they have to take that out within 10 years. So what that means is they're going to deplete that a lot quicker, and it's going to potentially cause more tax damage to the portfolio. So that's why it's really important if you're single or divorced, or you're thinking about leaving your assets to beneficiaries that are not a spouse, we should review this for you, because there are some different strategies to look at making sure you do minimize those taxes for them. Because let's face it, unfortunately, hopefully if we pass away, we hope we're passing away in our our 80s or 90s, and if we are leaving it to our kids, they're grown. And chances are they might be in their 50s still making good income. And now if you tack on, let's say, $1 million portfolio they have to take out over the course of 10 years, that's $100,000 extra they have to take out each year, which could increase their tax bracket. So again, very important to kind of look at that if you have a situation where you think it's not just necessarily going to your spouse, but you're trying to take care of other beneficiaries as well. Another good benefit they did was they took away the age restriction, where it used to be you couldn't make contributions to IRAs after 70.5, but now there's no age restriction. So you can be 85 years old working at the hardware store and be able, as long as you have earned income, you can still make contributions to an IRA or a Roth IRA. So that's actually a great change that they had in there as well. And then as far as the tax brackets, we're not going to kind of dig into them in too much detail because we got a lot to cover in this webinar. But ultimately speaking, they've stayed similar to where they've been in the past. They've just kind of indexed for inflation, but we're still under the very favorable tax treatment, I would say, with the 10, 12, 22, 24, 32, 35, and 37% tax bracket. So a lot of individuals, if we look at that third column, the married filing joint, a lot of individuals we work with, if you're going to be married, and let's say you're needing about $100,000 of income or so, you're going to be right there at that top of that 12% bracket. You'll see that it's $20,550 up to $83,000. So what that means is that's going to be your adjusted gross income. You tack on top of that the standard deductions over $20,000 means if you're making about $105,000 or so, you'll be in that 12% tax bracket, whether you're making it or withdrawing it. If you end up getting a little bit more than that, it jumps up into that 22% tax bracket. So that's a little bit of a jump there. So I mentioned or alluded to earlier Roth conversions. So let's say a couple, for instance, maybe only needs $60,000 a year for income, but their 12% bracket goes all the way up to $100,000. I'm just rounding for simple sake. That means they got $40,000 more they could potentially take out and pay only 12% taxes on. That they could do that and convert it to a Roth IRA. So that $40,000 now is going to grow tax-free and not just tax deferred. So this is one method. If you do this year over year and you manage those tax brackets, you can actually take advantage of the lower brackets we're in now and get some of that money out so you never pay tax on it again yourself or your beneficiaries as well. Now we don't know exactly where tax brackets are going to go, but with all the spending we've been doing, it's safe to assume they might go higher from where they are now. So even if you think you're going to be in the same income level, this may be a something that you'd want to employ. Usually we take a look at this, come fall, so we have a better idea of what your income has been for the year when we look at running those calculations. And long-term capital gains are still the same at 0, 15, and 20%. There is talk about those changing. We'll go over that in just a moment. But most of us are going to be in that 15% long-term capital gains bracket as well. And for any of the companies that we work with that have NUA capabilities, give us a call. We can go through that because there are some favorable tax treatments on that, where you actually pay a lower taxes on the cost. You pay ordinary tax on the cost basis, but lower long-term capital gains on the growth of your company stock. Now, the other question is, okay, where are you going to be when you retire? Are you going to stay in the same city or same state, or are you thinking about possibly moving? When we run that cash flow analysis, we actually are going to look at that. And so a lot of times we look at this graph here, there are some different states that don't have any state income tax, so that could save you quite a bit. Let's say, for instance, you're in California where you could have taxes close to 10%, and you move to Texas or Florida. That's a 10% savings year over year potentially on there. So it's really important to look at this. If you are staying in your state, we'll run the cash flow analysis for that. But if you have questions about potentially retiring somewhere else and how that could affect you, we can run that cash flow analysis side by side to show you how much money it could save you potentially over time. And it's not just the state income taxes. There are some different states that don't tax distributions, or they tax them differently at lower brackets. So there is a lot to know about the specific state as well. So just keep that in mind as you approach your transition to retirement. Let's talk a little bit about some of the changes we've seen under the new administration. Some of the current changes, which are kind of have already happened, and we'll talk about some proposed changes, which there was a lot of talk about them last year, but it looks like we may not actually get any of that, just given where the where politics are and the potential transition we're going to see this year. So first and foremost, what do we see over during the pandemic 2020, 2021? We had the Secure Act in 2020 that did go away. There were some benefits there where you could actually tap into your 401k or your IRA above and beyond the normal withdrawal options without the 10% penalty as well. That's no longer there. We had the Consolidated Appropriations Act. We had the American Rescue Plan. All those were the bailouts, if you will, where they were generating checks back to the general population in order to help through that pandemic. So those have since gone away. There are some things that they were looking to continue off of those, like the child tax credits. There are some adjustments to the alternative minimum tax credit because that was indexed for inflation, so they finally got that adjusted. So a lot of these have actually already happened, but the ones that are more concerning are the ones that could be proposed to change down the road. One would be raising the top tax bracket from 37% up to 39.6%. So not a huge jump and probably not going to affect most people we're talking to, but that is something where they're trying to gather a little bit more income potentially. Another one would be actually changing the long-term capital gains bracket. I went over that before, the 0, 15, and 22% to actually match your income. So this could be a big change. The good news is, though, what's been kicked around is it's only going to affect those that make over $1 million a year. So again, not most of us there, but if you do happen to make over $1 million a year, this could be a pretty big issue for you, because it would be that if you're making over $1 million a year, you could be up in that 39.6% tax bracket. Also, you've got the NIT tax there, so you're over 40% just on federal alone, and they could bring you from that 20% long-term capital gains up to match that 40% range or so. So if you do have questions on there, let us know. We'll be happy to run through that with you. The one I've got the most concern about is if they were to actually change the unrealized capital gains treatment. So what happens right now, and this could affect anybody, even individuals that only got $10,000 in the bank, but they've got a house and they pass away. So what happens is right now, if you pass away and your assets that are not your tax deferred assets, let's say like a house or brokerage accounts, art, things like that, if they pass on to your beneficiaries, they'll get a step up in cost basis for what that value is now. So let me go through a house as a quick example. Let's assume that maybe you bought a house 20 years ago for $200,000, and maybe now it's worth $600,000, so it's grown by $400,000. If you're to pass away right now, what's going to happen is that house will go to whoever your beneficiaries are, but they get a step up in cost basis, and it's worth $600,000. So if they sell it, in a year and it's worth $650,000, they only pay tax on the $50,000 of that future growth. However, if they change the unrealized capital gains, they could be hit for a tax bill on that $400,000 of growth that you have not paid tax on yet. So again, you bought for $200,000, it's grown to $600,000. That's one that really scares me because it could affect everybody across the board. I don't think we'll see that, or if we do see it, it'll be some kind of a variation of it, because we'll have a lot of fire sales on the real estate side if something like this comes to fruition. And then they've also are hoping to extend the child tax credit enhancements as well, as well as a couple other things there. So let's kind of transition to some 401k, transition to IRA tax planning options. We'll talk a little bit about inflation. We'll talk about your rollover option once you do retire, some potential after-tax strategies that you may be aware of, and then some different tax situations and how a conventional withdrawal strategy may or may not be the right process for you when you start taking distributions. But first and foremost, unfortunately, we're seeing things change right now. We're seeing inflation rear its ugly head. We've been talking about this for the last 2 years. However, it's been screaming through here so far in 2022. And a lot of that's obviously because a lot of spending we've been doing, also some of the bottleneck, but really the government spending. Through the pandemic, we spent about $5 trillion on plans. Attack onto that, the other infrastructure bills we've been looking at and stuff. But if you actually kind of put it, in relative terms, we spent adjusted for inflation about $4.5 trillion on World War II, all combined. So that shows you how much spending we've been doing. So it's going to have to get made up, either higher taxes and/or inflation, or a combination of those. So we've seen inflation move quite quickly here, and that's having a major effect on a lot of company plans when it comes to calculating the lump sum. If you're taking the pension lump sum, so if you have questions on that, give us a call. We can run your specific plans, because a lot of those change either monthly or quarterly or once a year, and we've seen a lot of people make some decisions right now because of that. And it's obviously affected the stock market as well here year to date. Now, as far as the impact on inflation, like I said before, these are a little bit behind, but what happened was we actually saw that jump from 7.9% up to 8.5% from February to March, which is the highest we saw since 1981. It has kind of leveled off a little bit here. We're only 1 month since then, so we'll have to see as we move through the summer what continues, if we are actually leveling off or not. The good news there is if we are going to level off, that could mean kind of a slowing of the pain for the bond market. We'll still see about the stock market here as well. But I think everybody knows how expensive things have gotten, whether it be gas or groceries or just pretty much anything across the board because of inflation and the bottlenecks of supply chain that we've seen as well. As far as dealing with individuals that we work with, a lot of different companies, when they do retire, a lot of them have both a 401k plan and potentially a pension plan. Alluded to before, the interest rates and how those affect the lump sum calculations. On the pension plan, usually you have a choice of taking an annuity for yourself or to cover you and a spouse in case something happens to you, and where you get a monthly payment for the rest of your life. Or you can look at the calculation and figure out what's the lump sum cash value they would give you for you to go out there and try and recreate that. And we've got other webinars that go over this in detail on each company, so just hit us up if you have questions on there. But ultimately speaking, if you do decide to take the lump sum, you can actually take that lump sum and your 401k, roll those over into one individual retirement account, which is an IRA account. There's no taxes on that because it's just going from one tax deferred to another. You don't take taxes till you physically take that money out. So this is one way to actually help consolidate things, make it easier as you transition, and also open up the world of investment choices to you. And your 401k, it could be as restrictive as only having 5 or 6 choices, or maybe 20 to 30 choices. But once you get to an IRA, you've got 10,000 choices. Whether that's good or bad for you, it depends. But you have the option of doing things on your own, or you can work with a company like the retirement group if you need us to manage it, or at least hold your hand through that process and give you guidance along the way as well. But ultimately, the best thing is to run that cash flow analysis to determine what are you trying to achieve, and then provide the best plan to reach those goals. So again, if you have questions on there, always give us a call. Another item that even if you're not retiring right now, we do see a lot of people taking advantage of, because there were discussions back in November, December about this going away. It looks like it's not going to, but that could always pop up again. But there is the option to increase your after-tax contributions in your 401k, and then turn around and actually roll those over directly to a Roth IRA, so they will actually grow tax-free versus tax-deferred. Now, again, we're talking to a lot of companies right now, so it's going to depend upon your specific company plan. Some allow you to do, or actually most allow you to do this. It's just a question of how much can you capture or not. So if you have any interest in doing this, or you think you've got some post-86 contributions in there, give us a call. We can run the numbers to show you what that benefit would be. But let's just say I'm, assuming over the years you've been putting some after-tax in there, maybe you got $50,000 in there. If you didn't do anything and kept it in there, and let's say you worked another 10 years, and let's hope it doubled, that 50,000 of growth would be taxable eventually in that 401k plan. However, if you were able to get that over to a Roth IRA, that 50,000 of growth would be tax-free. So that could save you quite a bit in taxes on that example alone. And then again, if you're younger and still continue to work, there are strategies to look at bumping this up, because it'll allow you to get around the limitations on just normal Roth contributions as well. So let's talk about the distribution strategy. Let's fast forward, assume that you have retired, and you're going to get your income from Social Security and taking distributions from your accounts. Maybe you took the pension as an annuity, or maybe you rolled it over as a lump sum, and you need to start taking distributions. Well, there's a couple different schools of thought to this, but the classic old school method was actually taking all your taxable accounts out first, so you can, essentially what it means is, the old school method is you want to defer taxes as long as possible. So they originally focused on taking your taxable accounts out first, so you defer your taxes even more. Then you tap into your tax deferred assets, and then you look at your tax-free assets, whether it be municipals or Roth IRAs last. That's not necessarily the best case. Let's take a closer look at kind of how that distribution strategy would look. So normally speaking, what somebody would probably tell you is, okay, the first couple of years, let's blow through your taxable accounts. That way you have zero taxable income, which is great. Then your Social Security kicks in, and you'll start taking tax deferred assets out on top of that. And eventually, once you run through those, you will actually have your tax exempt assets left to take out. Now, by doing this, what it's going to do, it's going to have zero taxes in the beginning, and then you're going to bump up higher taxes in the middle, and then lower taxes in the end. This is not necessarily the most tax efficient strategy to do it, especially in these lower tax bracket environments we're in right now. A more appropriate strategy would actually be to do kind of a combination approach. Let me zoom in here and focus on actually taking a combination of your tax deferred and your taxable assets, because what happens is, let's just assume a loan, you got a $20,000, joint standard deduction. That means you can take $20,000 out of your tax deferred accounts tax-free. So you might as well do that at least. So you look at combining tax deferred and taxable, then Social Security kicks in, and then you start to take some of your tax exempt assets on top of that. And so that way, what you're doing is you're able to kind of manage those tax brackets year by year. And that really kind of gets into that approach we mentioned before. If you're prior to age 72, the RMD, we can look at Roth conversions, so you can start to get more and more money over to that tax deferred, that tax exempt Roth IRA. So what that will do is it'll allow you more flexibility in planning and budgeting your taxes year by year. Because let's face it, like I said, chances are tax brackets will go higher down the road. So if I can manage to decide where to pull my income from, whether it be tax deferred or tax free, that gives me more flexibility, because tax brackets will likely change, every 4 or 8 years based upon administration. So you can budget that better if you've got more tax exempt assets through those Roth IRAs. But the process there is, fill your lower tax brackets with your tax deferred income each year. So again, at least that standard deduction, possibly more. And when you factor in Social Security, there's different tax treatments there. So you got to be aware of that, whether it kicks you into, any of it being taxed at all, or 85% of it being taxed. And again, focus on the Roth strategies as well, where we can kind of run all these together for you to kind of show you the best way to not just get your money out, but to keep more in your pocket versus paying taxes on it as well, for yourself and for your beneficiaries. Another way to kind of avoid taxes or reduce the tax issues is if you do happen to retire and take income before 59.5, there's a chance that you could potentially be looking at taxes plus a 10% penalty. So just be aware of that. There are some ways around that, especially if you retire from the company you work at age 55 or later. You can keep it in the 401k plan and take withdrawals there without the penalty. So be very careful if you're retiring before 59.5 and some advisors telling you to roll everything over to an IRA. As fiduciaries, we're not going to let you do that, because that's not the best case scenario, because if you do so, now you could potentially be faced with that 10% withdrawal penalty if you take it out early. There are other ways around that, doing substantial equal payments, whether it's for home purchases or medical expenses, but we can go through those one-on-one. And the other aspect, again, there could be NUA treatment in your stock plan, in your 401k plan. So if you have questions on there, let us know. And then at the end of the day, again, eventually you will have to start taking distributions with that RMD, which instead of 70.5 now it's 72. So it gives you a little bit more time before you have to kick those in. So again, it's really important to review that. But really between age 59.5 and 72 is kind of the freedom years, where you can take withdrawals if you want to or not. So you have more flexibility and control. So again, looking at managing your taxes year by year, that would determine the best way to take distributions, look at what it is you need. And then if you could afford to take more above and beyond that to get some of that transitioned over to a Roth, that would be a great strategy to save taxes for you and the next generation. But ultimately, the best way to do all this is by looking at a cash flow analysis. So again, take us up on that. Right now, about 3/4 of Americans over 50 actually don't have a written plan. Give us a call. We'll spend about maybe 10 to 15 minutes with you gathering some data. It could be shorter than that if you've already got the information on hand, but we can put that plan together in about a week and a half, get that over to you, and let you know if you're on the right path for retirement, or if there's any suggested changes you should look at. And then by knowing that, that can also help back into reviewing your 401k or any IRAs or other accounts you have that you may have questions about the allocation, see if you're set up appropriately for the market and for your retirement plans in the near future. And then ultimately speaking, obviously at the end of the day, we work with a lot of different companies. We'd love to work with you personally. If you're working with somebody already, that's great. We do understand that and hope that you're getting taken care of, but we would recommend getting a second opinion. We even recommend our own clients do this periodically just to keep us on our toes. But ultimately speaking, you need to make sure they have a deep understanding of your benefits plans, whether it be the pension, the 401k, healthcare options, because we've seen countless times where individuals have had advisors of 10, 20 years, but they didn't know that plan, and it cost them tens of thousands of dollars in the transition process. You understand the fee structure. You're going to have fees everywhere, whether it be in the plan, the 401k plan, stay in there, you'll still have fees. They'll be very low. But if you roll over to an IRA and work with a company, or if you do it on your own, there are going to be fees. So understand that fee structure and make sure you're getting what you're paying for. At the retirement group, we are fiduciaries, so we're transparent on all of that, and we're not a one-size-fits-all firm. Our goal is to, again, run that cash flow analysis back into what you need to achieve and provide options with you and go over those strategies and help you go through the pros and cons and pick the best strategy that fits you at that time. And then at the end of the day, what it is you value, just make sure that we understand that. And ultimately speaking, you need to run that cash flow analysis. Nobody should be giving you a recommendation without knowing what you're trying to achieve. So again, you need to run that review to find out what your goals are to back into what an appropriate analysis would be and how to help you manage a portfolio. And then at the end of the day, like I said, the best way to accommodate this is by scheduling a meeting with myself or one of the other advisors. You can always reach us at the main number at 800-900-5867, or you can reach us at info@theretirementgroup.com. We've also got a couple of QR codes up here. If you're tech savvy, go ahead and hold your cell phone up there. You can schedule a meeting with myself or one of the other advisors, or you can also follow us on our LinkedIn page. Once you get in there, you can get on the company specific LinkedIn page, so you get more information on webinars tied to your specific company, as well as if interest rate updates and things like that, if you're looking at retirement in the near future. So with that, I want to double check some of the questions we may have, and then we'll wrap this up because this was a rather long webinar. But let me see. First one I have in here. With the impact on inflationary pressures on my retirement, are there any steps I can take to insulate my portfolio and lump sum, or is it best to hold and weather the inflation storm? Okay, so both those kind of there's two questions there, because inflation is going to have an effect on both the market, obviously, which we've seen already. The negative impact it's had is obviously the stock market's pulled back, but it's been kind of a double whammy with the bond market getting rocked pretty well here, because again, inflation is driving interest rates up, which is driving bond prices down. So right now, just a classic asset allocation portfolio is getting hit across the board. But if we see inflation kind of level out, we should see the bond market start to rebound there. And then if you're talking about the stock market as well, there are different areas to focus for inflationary pressure. At the retirement group, we have a strong focus on value. You might have increased commodities. On the bond side, you might be shorter on the yield curve there. You might have more energy stocks. There are a lot of different ways to look at different sectors to mitigate some of that inflationary pressure. But again, from a long-term standpoint, it will be there, probably through the rest of this year, and we'll have to see what happens beyond that. But ironically, when we look at the, all the last like 10 times we've had inflationary pressure, again, on a long-term basis, the market has performed well. It's usually kind of the immediate short-term period kind of running into a potential recession or high inflation. We see some of those. Now on the lump sum issue, that's a bigger issue. If you're at a company and you're thinking about taking a lump sum and you're thinking about retiring in the next year or two, definitely give us a call. We need to review that with you. There's a lot of companies that our individuals are deciding to leave early because their lump sums are shrinking dramatically. A lot of those are based upon either monthly rates, quarterly rates, or annual rates. So we've seen some of those in the last quarter go up by over 1% on the interest rate scale, which means their lump sums have dropped by 10%. So if you had $1 million lump sum and you were to retire, let's say in June versus July, if you retire in July, it might have cost you $100,000. And the trend is not ending. We're still seeing rates continue to go up. So for a lot of different individuals, if you're thinking about taking the lump sum and not the annuity, you can see that dropping into the point where you're actually working for free if you hang on for another year or so. So it's really important to give us a call to look at that. If you're taking the annuity, it's not going to have an effect on the calculation, but obviously, as things get more and more expensive through time, your annuity value will erode. If you get $3,000 a month, pension right now, it's not going to stretch as far in 5, 10, 15, 20 years. So we can run those side by side in that cash flow analysis as well. So again, it's going to factor through both those, but give us a call. We'll kind of go through your personal situation, take a look at that analysis of your 401k or portfolio, and look at the pension plan as well. Another one, if I want to take a loan for my 401k, how do I do it? Okay, so this again is going to be company specific. You need to call your 401k department to process that, but the general rules are going to be that you can take out up to half of your 401k with a max of $50,000. But if you are looking to do that, give us a call. We can kind of run through the pros and cons there, because there may be alternatives to look at. Keep in mind, one thing that a lot of people don't understand is when you take that loan out, you're taking out pre-tax money, but you're paying it back with out-of-pocket after-tax money. So there is a slight double taxation there. But again, if you're needing to access it, usually the company plans will give you a general loan where you can access it for pretty much anything, have a 5-year payback. If you're doing it for a home purchase or a down payment, there's a longer term payback there, but you are paying the interest back to yourself. So again, you have to call the company to do that, but if you have questions on it, we can always run that for you as well and give you a comparison. And then I'm investing in stocks through my 401k. In this case, how to know how much amount of money I can take as a loan. Okay, so going back on that loan, I think I just answered that. The max you can take is 50% of your market value. So let's say if you had $60,000 in your 401k, you could take up to $30,000. with a cap of 50. So if you had $1 million, you could still only take $50,000 out of there. As far as the investments, it doesn't change the amount you could take out. What would happen is if you do take a distribution, chances are most plans take it proportionately from your allocation. So it's really more or less what your balance is, not what you're invested in for that. So I hope maybe that might have covered what that question was. If not, follow back up with us and we can dig into it for you. And the last one looks like here, and we'll wrap this up. What investment funds in the 401k do well in an inflationary environment? So again, this is a general webinar, so I'm not talking to one specific company, so I can't really tell you what your options are. But for most of you, there are limitations. You're not going to be able to kind of cherry pick inflationary environment stocks or sectors within the 401k too much. So the best thing is to, again, lean more heavily towards value stocks or value indexes, because again, a lot of times those companies will have more cash on hand to weather the storm a little bit better. And then also what they do is they'll keep cash on hand so they can focus on buying opportunities. So whenever things come into in a perspective where they become cheaper, they can pick those up as well. There may be some commodity exposure on the bond side. Again, you might want to look at keeping the yield curve a little bit shorter so you're not affected as much by inflation. But also don't forget that a lot of the companies, they have what is called a GIC, a guaranteed insurance contract, or it may pop up as a stable value fund that pays pretty good interest rates above and beyond what you get at a bank anywhere else as well. But the best way to run this again is, because I don't know what company this question is coming from, give me a call and we can actually take a look at your 401k and give you a review and let you know what those options are within the 401k plan and possibly outside the 401k plan. If you have rollover options, you might have more flexibility there, because a lot of companies give you the option to roll over a portion of your 401k before retirement as well. And once you retire or hit 59.5, you have access to more of it usually. So I know we covered a lot of different things in there, and hopefully that gave some generic information to you. But ultimately, if you have questions, give us a call at 1-800-900-5867. We can go through your specific situation. But again, remember, I covered the topics for general companies. We are not employed by nor are we endorsed by your specific company. However, for most of the companies we do extensive work with, we've been doing it for close to 30 years. So we've got a great understanding of those plans. And we'll be happy to hold your hand through that process and help you with the transition as well. But again, any other questions, feel free to reach out to us that we didn't cover, and we'll be happy to get back with you. Hope everybody has a great day, and I hope you stay safe.